Palantir is up over 750% over the last 5 years. Nvidia is up over 1,400% in the last 5 years. MicroStrategy is up 2,200% over the last 10 years. Seeing numbers like that and seeing investors flash their green profits on stocks like these, there's an obvious appeal to growth investing. But here's why I don't pick growth stocks. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that will be discussed is intended for information and educational purposes only and should not be considered investment advice or investment recommendation. Whenever you invest, your capital is at risk. Now, first things first, this is likely to be a controversial video, and that's understandable, as saying you don't do something is a challenge to the self-identity to a lot of stock picking investors. All I ask is to watch the whole video and listen to the whole rationale before complaining in the comments. So here's my logic. Stock pickers suffer from a kind of survivorship bias. The fact that we know of the successful ones is only because they've been successful, and we're only aware of the fact after the matter. In other words, we notice the winners after they've already won, and we forget about, or most likely you never even heard of, all the others that didn't make it. This gives us a false impression. It makes it seem like successful stock picking is common, or that it's easy if you're smart or work hard. But that's not really the case. For every investor that made a lot of money picking the right stocks, there are many more who lost money or did worse than average. We just don't hear about them, they disappear from the story. You can think of it like a talent show or the Olympics even, where we only see the finalists on the TV. We never see the thousands of people who tried out and didn't make it. And that doesn't mean they didn't try or weren't good, it just means we only remember the ones who made it through. And that's the survivorship bias. In the stock market, this bias can lead people to think that picking stocks is a reliable way to get rich. But in reality, it's very hard to beat the overall market, especially over many years. Some people get lucky for a while, but that doesn't mean they can do it again. Just because someone succeeded once doesn't mean they'll always succeed, or that we could copy what they did. Survivorship bias reminds us to look at the full picture, not just the success stories. If we only pay attention to the winners, we miss the lessons from those who didn't make it. You might see this play out with YouTubers who talk about investing. They often highlight their winning stock picks, the ones that made a lot of money or grew quickly, because those are exciting and get more views. But they don't always show the picks that didn't work out, and sometimes they quietly remove those videos or just never mention them again. And what about the stock picking YouTubers who never picked a winning stock at all? Chances are that you've never even heard of them. They might have stopped making videos or never gained enough attention to build an audience in the first place. In that way, survivorship bias affects who we even get to watch and learn from too. We end up seeing only the success stories again and again, and that can give false impression that picking the right stocks is easy or common when it's actually the rare exception. Here's what really happens in terms of the likelihood that you will get onto a winner. Very few active fund managers consistently beat their benchmarks, especially over the long term. According to the S&P Dow Jones Indices SPIVA, or the Indices versus Active reports, which are among the most respected sources on this, the results are striking. US equity fund managers over a 1-year period, roughly 40 to 45% of active managers beat their benchmark. Over a 5-year period, only about 20 to 25% do. Over a 10-year period, typically under 10% beat the benchmark. And over a 15-year period, it drops even further, often less than 5%. The pattern is consistent not just in the US, but across most global markets, including Europe, Canada, Australia, and even emerging markets. So even though some managers beat the market in any given year, very few do so consistently. And almost none beat the market after fees and costs over long periods. And these are people who are paid to do that. It's literally their job to beat their respective benchmarks. They can dedicate hours and hours per week, or even their teams hours and hours per week, to attempting to do that. We, on the other hand, have other things to do. But the fact that it's hard is not the worst thing. What's worse is that even if someone does beat the market for a while, it's hard to know whether they're actually skilled or just lucky. This is the real existential dilemma of stock picking. Not only is it hard to succeed, it's also hard to tell if you're actually good at it. Imagine flipping a coin 10 times. Some people will randomly get 8 or 9 heads. Does that make them expert coin flippers? Of course not, it's just chance. The same thing can happen with investing. A person might pick a few winning stocks in a row, but that doesn't prove they're skilled. It could just be a lucky streak. The problem is luck can look just like skill, especially in the short term. And by the time we think someone is good, it might already be too late. They could just as easily be about to enter a losing streak. In fact, research shows that even professional fund managers, the small number of ones that do beat the benchmark that is, even they often can't tell if their own outperformance is repeatable. So it's hard by itself to pick stocks successfully, but also hard to know if you're good at it, even when you think you're good at it. On top of that, I'm actually okay with average market returns. And that's why the bulk of my portfolio lives in what I call the boring middle. If you've seen my other video, a cheap global ETF fund, the ultimate guide, you'll know exactly what I mean. But in short, it's part of my strategy that doesn't try to beat the market, it just is the market. I use one fund, the Invesco FTSE All World UCITS ETF, accumulating for this. It's globally diversified, low cost, and reinvests the dividends automatically. No watching charts, no reacting to news, no trying to guess the next hot sector. Just buy regularly and move on with your life. And for convenience, as that name is a bit of a mouthful and it might be difficult to search, and I know there would be questions about it, I made a pie with this fund inside it as the only component. This means that you can find it much easier on Trading212 if you're following my public profile on there. You don't need to copy it or even hold it in a pie really, I just made it so it's easier for you to find. As it's an accumulating ETF, there's not even the benefit of having dividends reinvested within the pie, so copying it is fairly redundant, but welcome to if you prefer for whatever reason. I can link to the pie with the ETF directly in the pinned comment down below, so it's harder to miss. And speaking of Trading212, if you're planning to switch to Trading212, considering signing up as a new user, or even if you've signed up within the last 10 days, check the description for the up-to-date promo code free fractional shares sign-up offer. Usually I'd mention the code in the video itself, but the offers are subject to change, and it's much easier to edit the details in the description of a YouTube video than to edit the video itself later on down the line, if it changes of course. So when I say I'm okay with average market returns, what does that actually mean? Well, a global fund like FWRG tracks thousands of companies across developed and emerging markets. And historically, the average annual return for this kind of global equity exposure, after inflation, is somewhere around 7% per year over the long term. Some years it's up big, some years it's down, but if you zoom out far enough, that's roughly the long run trajectory. It's not exactly a get-rich-quick plan or an exciting YouTube video on 3 stocks to buy now, but it's not bad either. Compound that over 20 or 30 years and it's enough to change your life without needing to be lucky or good or even constantly switched on. Now, some people think that settling for market returns is admitting defeat, but here's something they might not know. Benjamin Graham, the father of value investing and Warren Buffett's own teacher, came to a similar conclusion later in his life. In a 1976 interview, Graham said, "I am no longer an advocate of elaborate techniques of security analysis in order to find superior value opportunities. This was a rewarding activity, say 40 years ago, but the situation has changed a great deal since then." He went on to say that for most investors, the best results would likely come from a simple portfolio invested in index funds, and this was before index funds were even popular. In other words, even the guy who literally wrote the book on stock picking came to see that beating the market had become incredibly difficult and probably not worth the effort for most people. And that ties into something called the efficient market hypothesis, the idea that stock prices already reflect all the known information. If that's true, trying to outsmart the market isn't just hard, it might be basically impossible over the long term. And that brings us to Jack Bogle, the founder of Vanguard. His advice? Don't look for the needle in the haystack, just buy the haystack. And that's exactly what I'm doing with FWRG. It owns thousands of companies across developed and emerging markets. It doesn't try to beat the market, it just is the market. So no, I'm not trying to find the next Nvidia or timing the next dip, I'm just building slowly in the boring middle where the wealth can grow in the background. But what about the rest of the portfolio? Aside from the boring middle, the metronome portfolio has 2 other important layers, the base and the tip, each with their own purpose. The base is the foundation of the portfolio that pays your bills. This is the most reliable part of the portfolio, the part designed to cover your minimum viable lifestyle through dividend income. It's made up of carefully chosen dividend-paying companies that keep ticking along even when the markets are turbulent. Picking dividend stocks is different from picking growth stocks. It's more like choosing the horse you think will finish the race, not necessarily the ones that will win the race. With growth stocks, you're often trying to find the next big winner, the company that will grow the fastest or deliver the highest return. It's a bet on outperformance and usually comes with more risk and more volatility. Dividend investing takes a different approach. Instead of trying to predict who finishes first, you focus on companies that are reliable, durable, and steady, the kind that keep running, keep generating profits, and keep paying out dividends over time. It's less about speed and more about staying power. You don't need them to sprint upwards on the chart. You just need them to make it to the end, quarter after quarter, year after year. These are going to be the stocks that help you sleep at night. They won't shoot the lights out, but they send you cash regularly. That means even during market dips, you still have income coming in, and that gives you an element of freedom. In my case, the base gave me a peace of mind during short contracts and unstable work periods like COVID, when my earned income was less predictable. Then there's the tip, the controlled outlet for risk. The tip is a small speculative slice of the portfolio set aside for high risk, high reward plays. Think along the lines of crypto, moonshot stocks, or that one biotech company you researched for 10 hours straight. This part is tiny, ideally less than 3%, but definitely less than 5% of the portfolio, and it's there to scratch the itch, to explore upside without endangering the rest of your financial plan. If it all goes to zero, no problem, you're still standing strong. But if it works out, you've got a little bonus. The key is that it's fenced off. You can be curious without being reckless. Why it's only worth it for asymmetric upside. If you're picking growth stocks, you're usually doing it for one reason, the promise of asymmetric upside. You're willing to take on more risk because you believe the potential reward is many multiples of your initial investment. That's totally fair in theory. But here's the question. If you're that confident in your picks, why not go all in? Why not use leverage or options or concentrated bets to maximize those returns? Because deep down, most people know the truth. They're not that sure. And if you're not absolutely sure, then taking big swings with your whole portfolio doesn't make sense. And that's where the logic starts to break down. And even if you were that sure, the irony is that there are more efficient ways to chase asymmetric upside than buying individual growth stocks anyway. If I believed a certain company was a 10x opportunity, I'd probably take that trade in the tip of my portfolio, where I can isolate risk, limit exposure, and still benefit massively if it works out. That's asymmetric thinking done properly, small downside, large upside, and limited capital at risk. But too many people flip that around. They expose their entire portfolio to high volatility growth stocks, hoping to win big. That's not targeted asymmetric investing, that's just gambling with poor risk management. The metronome portfolio is built around this exact insight. The base pays the bills, the middle compounds steadily, and the tip is reserved for ideas with genuine asymmetric return potential, where even a small allocation can make a big meaningful difference without putting the rest of the plan in jeopardy. So yes, asymmetric upside is worth chasing, but only if you pursue it rationally. And that means admitting that if you're not willing to go all in with leverage on your growth stock picks, you might not believe in them as much as you might think. So that's the full picture. The base gives you stability and income, the middle compounds in the background, and the tip lets you play a little safely. Each layer has a role, each keeps the other in balance, and that's the rhythm of the metronome portfolio. If you want to find out more, I made a detailed video on this portfolio structure here on the video called The Ultimate Guide to the Metronome Portfolio. But here's another thing that often gets overlooked when picking growth stocks. We don't get paid to research. Professional fund managers, those who spend all day analysing companies, reading financial reports, meeting with executives and building intricate models, they do it because it's literally their job. It's what they're paid to do full time. Most of us, we're doing this in our spare time, between work, family and everything else life throws at us. So we're competing against people who do this for a living using tools we don't have, with information we often get later, and with less time to act on it. That's a serious mismatch. And even then, as I pointed out earlier, most professionals still don't beat the market over the long run. So you need to ask yourself, if they can't do it with all their advantages, why would we expect to? And more importantly, why should we? Why spend hours researching stock picks when you could get solid returns with a simple diversified ETF that runs on autopilot? Unless researching stocks is something you truly love doing for its own sake, there's not much payoff for the average investor. We don't get paid to research, but we do pay the price in time, stress, and often lower returns just to chase an outcome that's statistically unlikely. And that's not a trade I'm willing to make. Final thoughts. I'm not here to tell you that growth stocks are bad or that no one should ever try and beat the market. If you love researching individual companies, watching trends, and making bold bets, that's totally fine. But personally, I've realised that chasing alpha isn't the path I want to take. For me, simplicity wins, predictability wins, and a strategy that actually works in real life wins. And that's why I built the metronome portfolio model. So whether markets go up, down, or sideways, I've got a portfolio that keeps ticking. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!